Hey guys, welcome back. I'm Chris, and this is the Midlife Crisis Podcast. Hey everyone, got another great show for you today. We're going to continue on our series of Back to Basics. Today we're going to be talking about mortgages. We're going to be talking about the different kinds, the advantages, the disadvantages, and the credit scores required. Kind of a little bit of a big picture for you guys. It's not going to be too much information, but it's going to help you guys as you guys are shopping around for mortgages to understand what the different types are. So here we'll see that there's actually 7 different types of mortgages that I chose for today's show. There are different types other than these, but I didn't want to get too broad on this. So the first type is going to be a conventional fixed rate mortgage. The second type, adjustable rate mortgage. The third is going to be an interest-only mortgage. There's going to be the VA mortgage, the FHA mortgage, USDA mortgage, and the jumbo mortgage. So those are the ones we're going to go over today, and we're going to kind of go through them, and we're going to break them down, one by one, so you have a little bit more understanding of what each one of them are. So your conventional fixed rate mortgage, this is going to be the one that you think of the most. This is the most popular one. This is the one where you're going to walk into the bank, you're going to say, I want to apply for a mortgage, and they're going to throw this paperwork down because this is the one that's most advantageous for everyone. The bank likes it because they know if you qualify for this loan, you have good credit and you pay your bills. For you, you're going to get a lower interest rate, things like that. So this is kind of the all-around one that they're going to try and sell you on first. So the interest rate on conventional fixed rate mortgage is going to be fixed through your whole term. So if you choose a 30-year or a 15-year, you're going to have the first payment be the same as the last payment. So it's going to remain the same for 15 or 30 years or whatever term you do choose. The interest rate is going to depend on the term though. So a 30-year mortgage is going to have a little bit of a higher interest rate where a 15-year is going to be lower. And you get the idea there. The bank kind of says that on a lower term, there's going to be less risk for them. They're going to have that money outstanding for, less time. So that's, they're going to reward you a little bit for that. This is kind of the best option for most buyers because it's stable and it's got a predictable payment and a clear payoff schedule. So you're going to know the day of your last payment. They're not going to throw any surprises at you. So this is a good mortgage in that kind of sense. So your minimum score on this one's going to be 620. That's going to change a little bit from bank to bank, but that's a rule of thumb. Next one we're going to talk about is the adjustable rate mortgage. This is pretty similar to a conventional mortgage, but the difference is that the rate is going to change over time, and the rate's going to be based on what the Federal Reserve interest rate is. So as their rate fluctuates, this rate's going to fluctuate. A lot of adjustable rate mortgages have a different term, like a 5-1. It might be a 30-year mortgage, but it's on a 5-1 term. So after 5 years, your interest rate is going to start fluctuating. So for the first 5 years, it'll stay the same. And then after that, it's going to become adjustable and it's going to go up and down with interest rates. So something to keep in mind. Your initial interest rate is usually lower because they figure they're going to make money on the back end. So they want to, entice you into this. It's good for buyers who plan to be in their home for a short term. So if you're only, moving to an area for a contract, or you're going to flip a house or something like that, or you just don't anticipate being there for long term, this might be a mortgage for you because you get the lower interest rate for the shorter term, and then you can either convert it or else you can sell the house and move on. The other reason you might want to choose this one is if you anticipate rates going to go down, like back in the 80s when rates went through the roof and people were paying 18 to 25% interest rates. This might have been a mortgage that would have fit in then, where they could have had it, and after a few years hope that, after 5 years hope that rate went down. So those are the reasons you're going to leverage a mortgage like this. The other thing is that your interest rate is going to be a bit lower. Interest rate on this is only going to be about 580 as your minimum score. So that's going to help a lot of more people qualify. The next one we're going to talk about is the interest-only mortgage. So the interest-only mortgage is exactly how it sounds. The payments don't reduce the principal. So all you're paying is the interest on the loan. So you're basically just renting from the bank, okay? So your money, you're just basically throwing it away. At the end of 30 years, you're not going to have anything if you don't pay anything down on the principal. The other thing about an interest-only loan is you're going to have to put 20% down minimum. So they want to minimize their risk, so they want a larger down payment so that they aren't putting too much of their money out there. It's good for buyers who only plan on being in the house short term or have an income structured that they can actually afford to put money down on the principal every year. So maybe they have a bonus structure where they have quarterly bonuses or yearly bonuses. This might be the one that they want, because then they can put just lump sums down, and then month to month, if they have a low salary, they're not stretching out their budget too much. So minimum credit score on this though is going to be 720. So that's going to be for people in the exceptional and excellent range. Next one we're going to talk about is the VA mortgage. Now, the VA mortgage is great for anyone who was in the service and served our country. These are backed by the VA. There's no mortgage insurance required, so that's going to help keep your monthly costs down. You're not going to have to pay that $100 to $200 a month of mortgage insurance. And there's no down payment. So, if you don't have the money for a down payment, if you served in the military or your husband served in the military, this is a great option for you. It's only available to veterans and their spouses though. And since it's backed by the VA, it's one of the easiest mortgages for veterans to get. So you're still going to have a 620 credit score to be able to qualify for this one. But, if you pay your bills and have some kind of credit history, you're not going to have a problem qualifying. All right, next one we're going to move on to is the FHA loan. Now, the FHA, that's the Federal Housing Authority. They insure this loan. So there is going to be mortgage insurance required, and you're going to have a down payment of at least 3.5%. So 3.5% is attainable for most people on a $200,000 house. That's only $7,000. So most people can swing that in the middle income range, maybe some of the upper lower middle income range. So this is a good option for those people. And it is insured by the FHA, so it's a lot easier for people to qualify for. It's best for people with low credit scores and low down payments. Most banks are going to require you to have some kind of pre-purchase class, maybe a pre-purchase home buyer's education class or a first-time home buyer's education class. They're going to want you to put a little bit of sweat equity into this for them to qualify you. But the great thing about this is your minimum credit score on this is going to be 500. So the next one we're going to talk about is the USDA mortgage. Now, these ones are backed and insured by the U.S. Department of Agriculture. So there's no down payment options available. So that's great for a lot of people, not having to put that money out up front. But this is only for buyers in rural and suburban areas. So, if you live in the city, you won't qualify for this loan. But if you live in the country or you live in one of our lot less populated states, you're going to be able to qualify for this loan. No down payment, and it's, of course, insured by the USDA. So, you will have to have a little bit higher credit score for this one, though, 640. Now, when I'm throwing out these ones like for the VA, the USDA, and the FHA, those credit scores are actually set by the agencies themselves, because these loans are actually going to be insured by government agencies. So they have a set of rules that they've set out as an agency to the banks, and the banks have to follow these. So the banks aren't actually setting these, and these aren't just numbers that are variable. These are set by the agencies themselves, because they're insuring your loan and acting kind of like a cosigner. So they're basically being your cosigner for these loans. So that's where those numbers come from. Now, the last one we're going to talk about, this is going to be for a small percentage of people out here, and this is called a jumbo mortgage. So a jumbo mortgage is the least common of all the mortgage types we talked about today. They can be fixed and adjustable rate. So, depending on your situation, your finances and stuff like that, you can choose either one. They require at least a 10% down payment. And as we kind of discuss this a little bit, you'll realize why. So these are for buyers with excellent credit and significant income. So this is going to be like an executive or a business owner or entrepreneur, someone who, has made a lot of money in their career and wants that reflected in their home. So they're going to be the ones that are buying, these $500,000, million, $1.5 million homes. Well, since there really isn't they're outside the guidelines that a lot of banks set for their conventional loans. This is a product that is designed specifically for them so that they can buy these bigger houses. There's going to be a lot more qualifications. They are going to require a large down payment, so 10% down payment. So if we're talking about $1 million house, they're talking about having to put $100,000 down. So this is for people who have a lot of liquid assets and are able to make these large down payments. So again, credit score on this one's going to be 700, so that's going to be in the exceptional to excellent range. So a lot of people aren't going to qualify for this in the lower and middle income ranges. So obviously, it's probably not something for them anyway, or for us. Anyway, I hope that you enjoyed the content. I kind of went through it kind of quick, but you can go ahead and if there's something you missed, you can go back and watch the video again, pause it on the parts. I laid out everything on the screen there, so you'll be able to kind of get a general idea. And if you want to just go back and pause it, you can write down all those details, figure out which one you can qualify for, and I hope that kind of helps you in your mortgage shopping process. If you enjoyed the content today, please hit that like button. If you want me to talk about something in a future episode, make sure to leave a comment down below. Click that bell notification icon so that you're notified when I upload new videos, and we'll see you next time.